On June 18, 2020, one of Europe's most celebrated technology companies was supposed to publish its annual results. Instead, its auditor delivered a different message. There was no reliable evidence that 1.9 billion euros in company cash actually existed. The money was supposedly sitting in two banks in the Philippines. The bank said the documents were false. Within 4 days, Wirecard admitted the cash was probably imaginary. Within a week, the company was insolvent. This was not a tiny startup operating from a basement. Wirecard had been worth roughly 24 billion euros. It was a member of Germany's most prestigious stock index. Its accounts had been audited. Its critics had been investigated. Its executives had been celebrated as the future of European finance. So how did $2 billion appear on a balance sheet without ever appearing in a bank? Wirecard sold something most people never notice: the machinery behind a payment. When a customer taps a card, money does not simply jump from one account to another. A chain of companies checks the transaction, moves the information, manages the risk, and makes sure the merchant gets paid. Wirecard presented itself as one of the companies building that invisible infrastructure. The business began near Munich in 1999. Its early customers included online merchants that traditional banks often considered difficult or risky. Markus Braun became chief executive in 2002, an Austrian technologist with a controlled public style. Braun described a future in which cash would disappear and software would sit at the center of global commerce. The story was perfect for the market. Digital payments were growing, banks looked old, Wirecard looked fast. Its reported revenue climbed, its reported profits climbed. It acquired businesses across Europe and Asia. Investors began to treat Braun less like the head of a payment processor and more like a visionary. Then, in September 2018, Wirecard entered the DAX, the index of Germany's leading public companies. It replaced Commerzbank, a lender founded in the 19th century. The symbolism was irresistible. The old financial order was leaving. A German fintech champion was taking its place. By then, Wirecard was no longer selling only a business model. It was selling an identity. Germany had produced world-class manufacturers, banks, and industrial groups, but it did not have many global internet companies. Wirecard appeared to fill that gap. Politicians visited. Analysts issued optimistic forecasts. Banks extended credit. The rising share price became evidence for the story that had produced the rising share price. And there was enough real activity to make the company convincing. Real employees built payment products. Real merchants used Wirecard services. Real customers carried cards issued through its systems. A false balance sheet does not require every part of a company to be false. It only requires the invented part to be large enough to hide what the real business cannot deliver. But the company's most important product was no longer payment software. It was trust. Part of Wirecard's growth came from what it called third-party acquiring. In places where Wirecard did not directly process a merchant's payments, outside partners supposedly processed them instead. Wirecard reported a share of the revenue. The partners were said to hold large cash reserves for Wirecard in trustee accounts. Outside Europe, Wirecard said it depended on acquiring partners because companies in the group did not hold the required local licenses. In 2018, the 3 largest partners identified in subsequent reporting were Al Alam in Dubai, Senjo in Singapore, and Payeezy in the Philippines. The merchants did not necessarily have a direct contract with Wirecard. Some dealt with another layer known as an aggregator or payment facilitator. Wirecard nevertheless recorded the transaction fees as group revenue, then recorded the partner's share as a cost. On paper, this could be a legitimate commercial structure. In practice, it created distance between the number in Wirecard's accounts and the customer supposedly producing it. The arrangement was difficult for outsiders to inspect. The merchants were far away. The partners sat behind private companies. The bank accounts were controlled through trustees. And yet this remote part of the business appeared to produce an extraordinary share of Wirecard's profit. According to the Financial Times investigation summarized in the later ESMA review, the 3 opaque partners were responsible for almost all of Wirecard's reported profit in 2018. When reporters visited addresses connected to partner businesses in Dubai and the Philippines, they found offices that were either extremely small or apparently absent. Companies listed as clients said they had never heard of the partner supposedly processing their payments. Normally, a bank balance is one of the simplest assets to confirm. An auditor contacts the bank independently. The bank confirms the account and the balance. The evidence does not need to pass through the client being audited. At Wirecard, the crucial proof often arrived through documents connected to trustees and third parties. That difference sounds technical. It was the center of the entire illusion. Imagine that a company tells you it owns a house. You ask for proof. Instead of checking the land registry, you accept a letter delivered by the company's own middleman. Now imagine the house is worth 1.9 billion euros. Wirecard's complexity gave it an advantage. Every new entity, foreign partner, and technical explanation made the business harder to challenge. Confusion could be presented as sophistication, but not everyone was convinced. Questions about Wirecard's accounting appeared years before the collapse. Analysts, short sellers, and journalists noticed that the company's profits and cash flows did not always tell the same story. Wirecard rejected the allegations and repeatedly argued that critics were attacking its share price. In 2015, the Financial Times began a series of investigations later known as the House of Wirecard. The reporting examined acquisitions, subsidiaries, and profits that seemed unusually difficult to trace. Then internal documents began to emerge from Singapore. A Wirecard lawyer named Pav Gill had helped investigate claims made by a whistleblower inside the company. The documents pointed to practices such as backdated contracts and transactions that appeared designed to move revenue between related businesses. The Financial Times published evidence from the internal investigation in 2019. Wirecard denied wrongdoing. It commissioned outside reviews, issued forceful statements, and pursued legal action. The dispute became a contest between two versions of reality. In Wirecard's version, confidential data had been misunderstood, documents had been taken out of context, and short sellers were coordinating attacks. In the other version, the complexity was not an innocent feature of a global payment company. It was the mechanism that prevented outsiders from matching reported revenue to actual merchants. German authorities also focused attention on possible market manipulation by journalists and short sellers. In February 2019, the regulator BaFin temporarily banned new short positions in Wirecard shares. It was an extraordinary measure. The state was protecting the shares of a national technology champion, while the underlying accounting questions remained unresolved. To supporters, the investigations looked like an attack by foreign speculators. To critics, the response looked like a company and a country defending the story they wanted to believe. Wirecard still had one powerful answer. Its financial statements carried the signature of a major auditor. Year after year, Ernst & Young had approved the accounts. But by late 2019, the pressure was too great to contain. Wirecard hired KPMG to perform a special audit. The company presented the review as the investigation that would finally clear its name. It did the opposite. KPMG spent months trying to reconstruct the third-party business. Its report, released in April 2020, did not declare that every allegation was true. It revealed something almost as damaging. For important parts of the business, the investigators could not obtain enough original records to verify what Wirecard had reported. KPMG struggled to confirm customer relationships and transaction data behind substantial revenue attributed to third-party partners. Requested documents arrived late, arrived incomplete, or could not be connected cleanly to the numbers in the accounts. That distinction matters. Not verified does not automatically mean fraudulent. But a financial company claiming billions in profitable transactions should be able to produce a clear trail from customer to transaction to bank. KPMG did verify limited pieces of the story. The later ESMA review notes that two partners had paid a combined 85 million euros into accounts at Wirecard Bank. That kind of real transaction made the larger system harder to judge. It offered a fragment of evidence that could be used to defend billions in reported business. But a verified fraction is not verification of the whole. The central problem remained. KPMG could not reliably reconstruct much of the revenue and profit on which Wirecard's success depended. Wirecard could not give the special auditors that trail. The report should have ended the illusion. Instead, the company highlighted the passages it considered favorable and insisted the review had found no proof of systematic manipulation. The market wanted a simple verdict. The audit delivered uncertainty. And uncertainty gave Wirecard a few more weeks. Its regular auditor was now examining the 2019 accounts. This time, the cash confirmations would receive more direct scrutiny. For years, the question had been whether Wirecard's profits were real. Now the question was even simpler. Where was the money? June 18, 2020. Wirecard delayed its annual report. Ernst & Young said it could not obtain sufficient evidence for 1.9 billion euros supposedly held in trust accounts. The amount represented roughly a quarter of Wirecard's balance sheet. The company said two banks in the Philippines held the cash, but the banks denied having a relationship with Wirecard and said the confirmation documents were spurious. The collapse came so quickly because cash is different from a complicated revenue model. Revenue can be debated through contracts, definitions, and accounting judgments. A bank balance is binary. Either the bank confirms the account or it does not. Once the supposed banks rejected the documents, Wirecard could no longer hide behind complexity. June 19th, Markus Braun resigned as chief executive. Jan Marsalek, Wirecard's chief operating officer and the executive associated with the Asian business, was dismissed. June 22nd, Wirecard issued the sentence that destroyed what remained of the company. There was a prevailing likelihood that the 1.9 billion euros did not exist. The money had not been stolen from those accounts. The accounts were not what investors had been told they were. June 25th, Wirecard filed for insolvency. It became the first member of the DAX to collapse in this way. In 7 days, a national champion became an empty shell. Shareholders were devastated. Creditors were left with claims worth billions. Employees who had built real products inside the company watched their jobs disappear beneath accounting they may never have seen. And one of the most important people in the story was already gone. Jan Marsalek told colleagues he was going to the Philippines to help locate the missing money. He never returned. Investigators later concluded that records suggesting he had entered the Philippines were false. Reporting and official investigations traced his escape through Belarus, while later evidence placed him in Russia. German authorities issued an international appeal for information. Marsalek remains a fugitive. The story became stranger after Wirecard. British prosecutors described Marsalek as a figure connected to a Russian espionage network. In 2025, 3 Bulgarian nationals were convicted in Britain for spying operations that prosecutors said he helped direct. The executive who controlled Wirecard's most mysterious business had disappeared into an entirely different world of intelligence contacts, false identities, and covert operations. But his escape can also distract from the larger question. One missing executive did not sign years of audit opinions. He did not design Germany's regulatory system. He did not force investors to ignore the warnings. Wirecard was not only a story about an alleged fraud. It was a story about an entire chain of people outsourcing doubt to somebody else. Wirecard owned a regulated bank, but the wider group was largely treated as a technology company. Oversight was divided among institutions with different responsibilities. Germany's financial reporting enforcement system also had 2 levels. A private body called FREP performed initial examinations. BaFin could intervene at the 2nd level. After the collapse, a review by the European Securities and Markets Authority identified serious weaknesses. Among other findings, it said that warning signals in international media had not led to Wirecard being selected for examination between 2016 and 2018. It also raised concerns about parts of BaFin's internal controls and the effectiveness of information sharing. The auditors had a different failure. For years, the accounts were approved without the decisive cash being confirmed directly from the banks that supposedly held it. Investors had their own blind spot. Every increase in the share price made the company look more credible. Admission to the DAX looked like validation. Criticism could be dismissed as an attack on Germany's future. The scandal forced Germany to dismantle its 2-tier reporting enforcement model and give BaFin stronger direct powers. It also intensified European scrutiny of audit supervision and the way regulators monitor public reporting. Those reforms arrived after the trust had already been spent, and the company understood how to weaponize that confidence. It did not need every person to believe every number. It only needed each person to assume that someone else had checked. The bank trusted the auditor. The investor trusted the regulator trusted the reporting system. And the public trusted the prestige of a company that had become too important to question. The criminal case against Markus Braun began in Munich in 2022 and remains ongoing as of July 2026. Prosecutors accuse him and other former managers of fraud and false accounting. Braun denies the charges and says he was deceived by a group centered on Jan Marsalek. Marsalek remains wanted. The missing 1.9 billion euros was the number that brought Wirecard down. But the real asset supporting the company was never cash. It was borrowed credibility. Credibility from an auditor's signature, from a regulator's protection, from a prestigious stock index, from every person who decided that the next person in the chain must have checked. The money never existed. The trust did. And that was enough to build a 24 billion euro company. This is the last audit. Subscribe for the next investigation, because every empire leaves a paper trail.